afternoon, friends. In the lecture series on fundamental of investment, we are talking of approaches to security valuation. In my previous lectures on approaches to security valuation, I discussed that there are three broad approaches of valuing securities, or put it straight, valuing shares: fundamental analysis, technical analysis, and efficient market hypothesis. In my previous lecture on fundamental analysis, we were talking of economic, industry, company analysis. One of the important approach of fundamental analysis, or one of the way of making fundamental valuation of equity share, is EIC approach. What is fundamental analysis? Basically, we tries to find out the intrinsic value of a share. When I talk of intrinsic value, what it implies is that in the fundamental analysis, we value a security on the basis of cash flow technique. That is, how much cash inflow that investment, or that, put it that way, the security will generate over a period of time. On that basis, we value a security. And in the fundamental analysis, we use economic, industry, and company analysis approach for valuing equity shares. So in the discussion, we talked about the economic analysis. If I put it in one or two lines, I would say, in my previous lecture on economic analysis, I said that if economy is doing well, if economic fundamentals are good, like if the GDP is growing, per capita income is growing, the macroeconomic scenario is good, the microeconomic scenario is good, certainly it will lead to good valuation of equity shares, because the basic presumption is, if economy at a time when the economy is doing well, there is a greater likelihood that the securities, that is the shares, the companies will also perform well, and they will command good premium. When the economy is growing at a faster rate, the macro scenario of the economy is good. At that point of time, the stock market booms, right? So this is called EIC approach, and we discussed in the EIC approach economic analysis. And I also started in my previous lecture on the industry analysis. Means there are three important aspects of valuing the economic analysis. We make economic analysis, what is the economic scenario of the country at the country level, right? And even at the international level. And then we talk of the industry analysis. In the industry analysis, we can talk of the industry life cycle. As you are aware, that industry means group of companies engaged, operating in the similar type of business. That is what we mean by industry. If I say textile industry in India, what it means is that all those companies which are engaged in the textile business, which are engaged in the, say if I talk of the manufacturing business, which are engaged in the manufacturing of textile, whether it's a small size company or is a large size company, they comes under the textile industry. So what we see in the industry analysis is that what is the life cycle stage of the industry. As you know, in the marketing, you must have studied product life cycle. Similarly, there is a life cycle of the industry also. We say startup stage, growth stage, maturity stage, and declining stage. These are the four stages. In the startup stage, we presume that the industry is new, the technology is new, the industry is, the product is not recently being launched in the market, means the product is novice in the market. So there is a lot of uncertainty. There is a demand in the market, but there is a demand uncertainty in the market. So the endeavor of the companies is to increase, the endeavor of the industry is to increase their demand, to create product awareness. And in such a scenario where heavy expenditure is being made by the industry, by the companies, and group of companies means industry, by the industry. So in such a scenario where advertising expenses are high, the marketing expenses are high, the profits are not very high, because in such scenario, the expenses, because the benefits of the operating leverage and financial leverage is not coming to the company. So that's why the profits is a uncertain and the profit level is not high. So in such a scenario, industry doesn't command very high premium. Means the share prices, the companies which are operating in that industry doesn't command very high share prices, right? The second stage is growth stage. Growth stage is a stage where the sales is growing, the profits are going, It is a situation where the company's sales rate starts growing at a faster rate, and gradually in the third stage I will be talking of the sales rate, the growth of the sales rate starts declining. Like say for example OTT industry in India, especially during the COVID time, the OTT industry get a lot of boost, means the demand, the sales growth of the OTT industry increased at a very fast rate. So those companies which are engaged in that business, they made their profit at a very high rate. In such a scenario, when the industry is passing through a growth stage, in such scenario, companies command good profit, company's sales is high. So when the sales is high, the profits are high, certainly the share price of that industry also commands good premium, good higher price. So those industries which are in the growth stage, the companies engaged in the business of that industry, they make good profit, so the companies command higher sales price. The third is maturity stage. In the maturity stage, the sales reaches its peak, right? And the rate of growth of the sales starts declining, right? So when the rate of growth of the sales starts declining, is such a scenario, the company do not make higher profits, right? Means the growth of the profit also starts declining. I am not saying that the profits will not increase, but the rate at which the profit was growing, I mean that rate starts declining. The rate of growth I am talking of, right? So if the industry is passing through such phase, the share price also doesn't command very high price, right? So those industries, those companies which are in the industry which is at mature stage, right? So I mean share price starts slowly and gradually declining, or I put it this way, market don't value them very high price. And finally, declining stage. So declining stage is a stage where the sales starts declining, the profit starts declining, negative rate of growth. So in such a scenario, the share price of those companies, those industries, right, which are in the declining stage, they are also starts declining. So as an investor, you should not invest in an industry where the industry's life cycle is at declining stage. So these are the four stages, means we must see what is the life cycle of the industry. Whether the industry is a growing industry, in the growth state, it is best time to invest in such industry where it is a growth stage, and the introduction stage. And if you have a high conviction level that the industry is at the introduction stage, and if you have conviction that this industry is going to do good because of the various factors, right, in that is the best time to invest in those companies in that industry. The other thing in the industry, what we see is nature and type of industry. The first point I discussed was the life cycle of the industry. Now I am talking of nature and type of the industry. When I talk of nature and type of the industry, different industry have different characteristics. There are certain industries which are growth industries. Given the demographic feature of the country, given the income level of the country, given the economic scenario of the country, you expect that this industry will keep on growing for a reasonable long period of time, right? Those industries are called growth industry. Like for example, I say pharma industry in India. India is having large population, more than 135 crore people, right? And as the income level is increasing, so the expenditure on health is also increasing in the country. So demand of the pharma companies, those companies which are engaged in the pharma business, the manufacturing of medicines, hospitals and all those, right, the demand is going to increase because the government sector, there is a limit in which the government sector, the health industry can grow, right? So certainly there are many private companies which are coming, there are many good hospitals, there are good pharma companies which are coming in the market, and which are there in the market, they are growing at a fast rate. So such companies, such industry enjoys good profits, so the market value higher prices to such industries. Means when I am saying industry, means companies engaged in that industry. So there is a growth industry. Then there is a cyclical industry. There are certain industry which are of such nature, which are of cyclical nature. Like say for example, commodity companies engaged in the sugar business, companies engaged in the steel business, companies engaged in the cement business. These are called cyclical industry. The price of steel is being affected by the international steel prices, right? The prices of sugar are affected by the international sugar prices. So there is an upswing in the industry, there is a downfall in the industry, right? So these industries move in a cyclical manner. When the cycle is on the upside, that industry commands higher price. When I'm talking of the price, means share price. When the industry is as a declining stage, right? In such a scenario, the industry doesn't enjoy high price. When I'm saying industry, means the share price I'm talking of. Time and again I'm repeating, basically we are talking of the share price. So all these companies which are engaged in the sugar business, which are engaged in the steel business, the cement business, they're all of cyclical nature, right? So when there is a boom in the industry, they grow at a fast rate. When there is a depression in the industry, same is the case with the real estate sector, right? See, for the last 5-7 years, the industry was at a depression stage, and for the last 1 or 2 years, I would say, the real estate sector in India, all those companies which are engaged in the housing sector, right? So a company like DLF, company like Godrej Industries, I mean all those companies, Oberoi Realty, all these companies which are in the real estate business, they are getting good price in the market. So the nature of the industry is that they are cyclical nature. Some are called defensive industry. Defensive industry means their sales and profit is not being much affected. I'm not saying not at all, but I'm saying not much being affected by the ups and downs of the market, right? Means their demand is such that it keeps on increasing at a slower rate, like FMCG companies. Companies engaged in fast-moving consumer goods, like company like Colgate, company like Dabur, company like Hindustan Unilever, right? So these companies which prepare toothbrushes, toothpaste, washing powder, I mean all these type of product which are of normal consumption, these has become our habit, right? So they are called defensive industries. Industries engaged in the utility, say for example, power producing company, power distribution companies. They are called defensive industry, right? So their prices are regulated by the government. So since in the public utilities the prices are regulated by the government, but there is always a demand. There is a demand of power in India. The power supply is limited in India. So whatever the production that is being made by the power companies, power industry, that is always being demanded, at least in the near future, I can talk of, right? So these are called defensive industry. So nature of the industry is such which are of defensive nature. They are not much being affected by the business cycles. Then comes cyclical growth industry, right? They are of cyclical nature, means there is ups and downs, but they are growing. Like in India, automobile industry, I can categorize it in the cyclical growth industry, right? All these companies which are engaged in the four-wheeler industry or two-wheeler like Bajaj Auto, Hero Honda, Maruti, all these companies which are making Tata Motors, these are either making four-wheelers or two-wheelers, right? So they are cyclical growth industry. In the cyclical growth industry, technology is changing fast, and because of the change in the technology, the new and new models are coming. If you recollect some 10-15 years back, a very few car companies were there in India, and there were few models in India. But nowadays in the automobile sector, every month you will see new model of a car in the market, right? So these are called cyclical growth market, because technology is changing fast, because the new models are coming. That's why companies are able to price their new model at a higher valuation. So because of higher valuation, they command good profit, and industries engaged in this business, they command good stock prices also. Like the other considerations apart from these two things which I talked of, the life cycle of the industry, and I also talked about the nature of the industry. Nature and product of the industry. What is the nature of the product? I'm not talking of the industry as a whole. I'm talking of now nature and product of the industry. Nature of the product has a bearing on the industry growth and the profitability. If the product is seasonal and agriculture, growth rate depends on monsoon, right? So when I talk of sugar, the sugar production in the country, and those companies, those industry which is in the sugar industry, like say sugar industry, the price depends on the good monsoon. If there is a good monsoon, there will be good sugarcane production in the country, and if there is good sugarcane in the production in India, there will be larger production of by the sugar industry, and they will be making good profit. So if the product is material or an input to be used in other industries, the growth rate of such an industry depends on the parent industry. So this is one of the nature of the industry. Nature of competition. Nature of competition also decides about the nature, about the product and about the price of the share. If there is a stiff competition in the industry, like say for example textile industry, there is a stiff competition. Steel industry, there is a stiff competition. Cement industry, there is a stiff competition. So if the competition level is very stiff, such companies do not enjoy pricing power. They cannot differentiate their price of their product with that of the other companies. So since there is a low profit margin because of the price competition, obviously the companies will not able to make very high level of profit. And because the companies are not able to make high level of profit, because the nature of the product, nature of competition is such in the industry, right? So companies engaged in that business, if the nature of the industry is such, nature of competition in the industry is such that the pricing power is not there with the industry. So in that case, the share price will not be very high. Means you will have to value those shares at a reasonable value. You can't give them premium to those companies or those industry. Right? So the degree of competition has an impact on the industry growth prospects. Industrial policy of the government. This is also a very important and significant point. What is the policy of the government towards the industry? There are certain industries which are considered as the priority industry for the government. Right? The industry which is engaged in the strategic business. Nowadays the government of India is giving lot of focus on defense industry in the country. Earlier, we used to import lot of defense equipments from outside the country. Nowadays, the government of India is focusing that more and more defense equipment should be produced within the country. And it is a protected industry. So, because of the protection given by the government, this industry can enjoy lot of benefits which are being offered by the government. So if the industry is protected, if there is an entry barrier, right, so enjoys tax exemption, special subsidies, so such companies will have good pricing power. Such companies will able to maintain their sales, maintain their growth, because the entry is restricted. Not many companies can come into the business. There is a tax exemption, because the government feel that it is a strategic sector. There is a need because of our geopolitical situation in the world. There is a need to promote defense sector, right? So in order to promote, the government is giving tax exemption, government is giving various concessions to the industry. So such companies can enjoy good pricing power in the stock market. Means the industry can have a higher price premium, right? So those companies which are engaged in that industry, they will command good share price. You can value them at a high rate, right? And like the small scale industry is being given lot of benefits by the government of India. Labor condition and trade unions. In some part of the country and in some industries, there is a very strong trade unions, and normally these trade unions have conflict with the management, right? These conflicts makes an impact on the productivity of the workers, right? So if the productivity of the workers is being affected negatively, the profitability of the industry will not come. And if the profitability will not come, obviously the growth of the profits will not come, and companies' profits, because of the company's lower profits, the company will not enjoy a higher price in the stock market. So such a conflict can lead to disruption in the industry. And in the stock market, while you value the share, you don't give high value to those industries where there is a lot of disruption in the industry. So the very nature of the industry is such, where there is often conflict between the management and the workers. So there are strikes, there are lockouts. Such situation is not a good scenario for the industry. And we also say there are certain traditional industries, there are new economic industry, or we call it new age industry. If I talk of the name of the companies, like company like Nykaa, company like say Policy Bazaar, company like Car Trade, Zomato, these companies are in the new age industry where you are, what you do in Nykaa is whatever you have to purchase, there are few stores, they are selling premium products, and most of the sale, large part of the sales comes by way of the online shopping, right? So similarly, Car Trade, Policy Bazaar, they sell insurance. Policy Bazaar sells insurance online only, right? So these are the companies which are new age companies. So if these new age companies, the uncertainty is high. If they do well, certainly the profits will high because they can command higher premium. There are certain traditional industry like FMCG, fast moving consumer goods, right? So these are traditional industries, steel industry, say again textile industry in India. They are traditional industry. When India became industry, the only industry that was developed in India was the textile industry, right? So these are traditional industries. They don't command very high pricing power in the stock market. But new age industry, they command high pricing power in the industry because the growth possibility of the growth is very, very high in the new economic industry. That's why you must have seen these new age companies, they have come out in the stock market, they are startups, and they have come up with a very high premium in the market. They have issued their IPOs recently, and these new age industry, these new age companies, they have issued their share price at a quite high prices in the market, and people subscribe those shares because they think that the rate of growth of this industry will also be very high given the demographic features of the country, right? Degree of operating leverage and financial leverage. There are certain industries where the fixed cost is very heavy, like power sector, where the fixed cost, so these companies are highly operating leverage. If suppose the demand of power decreases, so variable cost will decrease, but the fixed cost will remain same. Since the fixed cost will remain same, so profitability of those companies where the operating leverage is high will come down. And if the other way around, if the sales increases, there is a boom in the market, there is a boom in the demand, so the company's profit will increase at a very fast rate because of the benefits of operating leverage. Because the fixed cost will remain same. In the power sector, a very large part of the cost is fixed cost. Since the fixed cost will remain same, if you increase the power production, it is only the variable cost that will increase. So only the variable component will increase. So it will lead to the higher pricing, higher price and higher profits in the market, right? So this is called operating leverage. Similarly, we call it financial leverage. If in the balance sheet of a company, debt portion is very high, it means your interest outgo is very high. So if the interest outgo is high because of the higher debt, financial leverage comes because if there is a higher debt in the balance sheet, means you have taken lot of bank loans, lot of debentures, borrowed money is very high. So if the component of the borrowed money is very high, the financial leverage, the risk will be high. In a scenario, if you are doing well, it's good. If you are not able to do well, means that if the sales declines, then there will be a very high impact on the profitability of the company. So degree of operating leverage and financial leverage also impact the pricing in the stock market. So investors should prefer industries that have lower sensitivity to business cycle, right? So this is about your industry analysis. So what we see, to sum up, that in the previous lecture I talked about economic analysis. In this lecture we have discussed about the industry analysis, in which we see what is the nature of the industry, what is the nature of the product that industry produces, what is the life cycle of the industry, what type of the product that industry produces, what is the nature of the product that industry produces, what is the operating leverage and financial leverage, whether the industry is of traditional nature like textile, like other industries, and whether the industry is a new economic industry, means new age industries where the sales is growing at fast rate and there is a lot of technological innovation that is being made, and because of that technological innovation the company enjoys higher pricing power, right? So these are the features of the industry, and looking at the feature, because if you are in the right industry, it means you will able to command high profit. The basic premises is, if you are in the right end, when I am saying right industry, no industry is right or wrong. Means right industry means where the chances of growth of sales is high, the technology is good, the working conditions are good because of the trade unions and all those things. So in that industry, the share price, the companies engaged in those industry will command higher prices in the stock market. So this is about industry analysis. In my next lecture, I will be talking of company analysis. Thank you.